good morning and good afternoon, depending on where you are. I'm on the West Coast in BC, so it's still morning. So I'm between you and lunch, so I'll get moving on this. So today I'm going to be presenting really one of our sweet spots here at Desjardins, and really a great staple product that we do very well on, especially here in BC, of course, across the country as well. So it's called the Executive Health Plan. Essentially what it is, it's shared ownership critical illness. It's really a great way for you to get into that business market, that incorporated business market. We have advisors that actually their entire practice is on selling this product. So you know that there's a massive opportunity for this within your client base. So my name is Petra Ross. I'm the wholesaler in BC. I've been in the industry nearly 20 years. I'm extremely passionate about those living benefits and those products that protect yourself first so that you can continue working and continue protecting your company and your income. So we will take questions at the end. Normally I would take questions throughout because this is such a short presentation. I'm just watching on the time. We will keep them at the end, and I can see the chat there as well. Okay, moving forward, we have a quick disclaimer, of course, from our legal and tax department, essentially just saying to please look or, consult your own professional advice. So moving forward on the disclaimer. Okay, so when you're speaking to business owners and you're chatting about risk management, so all of you are risk managers, and when you're speaking to them, there's a number of ways they can deal with risk in their business. So they can avoid it. So essentially avoiding a project, perhaps they can retain the risk. So perhaps they're self-insuring. They can reduce the risk. So they can, perhaps only do things during fair weather times, and then or have employees on contract, that sort of thing. That would be reducing risk. Or of course they can transfer that risk. An insurance product is really the way that business owners are transferring risk. So any type of insurance, whether it's a property and casualty product, business continuation, any of that type of product, you're transferring the risk to the insurer. That's what we're doing here. We want to transfer the risk of suffering a critical illness to the insurer. Now, are you and your business at risk? So these are some of the questions that you would essentially ask your client. So in the event that your client suffers a critical illness or has to have time off work, it's would your business suffer financial losses if you became too ill to work for an extended period of time? And how would your company's suppliers and creditors react? We know that they would react very poorly. Of course, they would stop booking contracts with you. And then could the company, so you, the business owner, could you continue to pay your employees if projects got delayed or canceled because you had to take time off work due to a critical illness? These are really important factors, and these are things that the business owner is concerned about. Okay, but where will the money come from in the event that your client were to suffer a critical illness? So if they did have a heart attack, a stroke, any type of cancer, MS, Parkinson's, so many other coverages, 26 covered conditions, where would that money come from? So, business owners and many clients will say that, okay, well, I'll take it from the company. I'll take it from current cash flow or retained earnings, or I'll sell the business. Now, of course, we know business owners don't want to sell the business in the event that something happens. Retained earnings, well, why would you want to use retained earnings to fund an illness when you have the ability to purchase an insurance product that would do so? Furthermore, this insurance policy actually is a way to pull money out of retained earnings and receive the money back non-taxable to the shareholder. Where would the business owner get it if they went as the shareholder themselves? Do they go to non-registered or registered savings? Well, we know the impact to RRSPs if you were to have to withdraw. Mortgage, equity, line of credit, depends on your clients whether or not. And with interest rates what they are right now, you really don't want to have that as a solution. Bank loan or line of credit, we know many, financial institutions are not in a position to lend money to individuals that have suffered a critical illness or off work. Family members, friends, okay, maybe in the short term, but as business owners and entrepreneurs like yourself, they want to make sure they're able to get up, go to work, and support themselves. I mean, you're an entrepreneur yourself. You know that your business owner clients, they're the types that are, you want to rely on yourself. You get up, go to work, you can earn far more going to work for yourself than somebody else. Now, but what about a lump sum payment from a critical illness contract and having a shared ownership critical illness policy? So it really is a shared ownership CI. So both the corporation and the shareholder are named as policy owners. It's the ideal client is for private incorporated companies. So small companies, professional corporations, or companies that have accumulated retained earnings. So even PRECs, we've seen it commonly with realtors. We work exclusively with the CDSBI. So that's the Canadian Association of Dentists. They work with clients, of course, dentists that have those retained earnings. They see the impact that a ill health or cancer could affect them. Some of them have actually purchased a practice because someone has gone on disability or someone has had poor health. So they know the impact of a critical illness and they want to protect that. And yet they have the funding from their retained earnings that they want to use into a policy that they would actually receive back non-taxable to the shareholder themselves. So we want to have it for companies that have an active shareholder, of course, themselves, 25 to 59-year-old. We see it really well for, as I mentioned, large companies, but also small. We have it where it's multiple shareholders, you do multiple policies, or of course, a single, like I said. One that I always speak about is, it was an incorporated dog groomer. So we see there's really no limits to the size of a company or number of employees. Now, a couple probing questions for getting into this product is, what would happen to your company if you suffered a heart attack, cancer, stroke, or other critical illness? Could your company survive without you for the next 6 months? So put more simply, essentially say to the client is, how long could your company survive without you? So, the client will get into, well, what do you mean? Well, if you were to suffer a critical illness, how long could the company survive? Would you want a policy to protect that? And in the event that you don't have a claim, you get 100% of the premiums put into the policy back to you non-taxable. The next question is, are you interested in a solution that will protect your company if you have a critical illness, but if you remain healthy, will allow you to recover up to 100% of the premiums paid by you and the company? So again, this is great, but a little bit wordy. So I would really try to focus on figuring out how to simple this or put it into simple layman's terms. So are you interested in a strategy that takes your money from the retained earnings out of the business and back to you as the shareholder non-taxable? So that's another way to phrase it. Okay, so what exactly is shared ownership? What is shared ownership critical illness? So the company must have a need for insurance CI coverage, for critical illness coverage. The reason for that is that there must be based on the technical bulletins that we've reviewed from the CRA, there must be an insurance need. So, for example, the company must be impacted financially if the shareholder were to become ill. So they are an active, participant in the business, an active shareholder versus just a silent party. So the company and the shareholders are co-owners. So they're both actually named as policy owners of the CI policy with return of premium benefits at maturity and death. So that means that regardless of whether the client dies, unfortunately, or if they were to surrender the policy, they're going to get 100% of premiums that are paid into the policy by both the shareholder and the corporation. They're going to receive that back, 100% non-taxable to the shareholder. Now, the company is going to own and pay for the critical illness benefit. So that's the basic benefit. We cover 26 covered conditions, as well as the death benefit. So the death benefit is the higher of the total premiums paid on the date of death, or at least 25% of the CI benefit. So within all of our critical illness policies, we will actually pay a minimum of 25% of the CI benefit for our return of premium on death. So if, for example, your client had $1 million policy that they purchased, unfortunately, they died a year after buying the policy, we will pay a $250,000 death benefit to the corporation. So that's part of what we do special as far as for all of our CI policies, we have that minimum 25% CI benefit or return of premium there. Okay. Now the shareholder will own and pay for the beneficiary of the health benefit. So the health benefit is that return of premium on surrender. So we've renamed it the health benefit. Now, if no critical illness or death benefit has been paid out, the benefit up to total all premiums paid to the health benefit payment date, so will be paid back to the shareholder at surrender. So the return of premium essentially is what the shareholder is owning and paying for. And the total premiums paid by the corporation and the shareholder get paid back to the shareholder non-taxable. Now, what we're saying here is that the company's portion of the premium must correspond to the cost for equivalent term coverage for the same duration in order to minimize the risk of corporate impoverishment and the resulting benefit to the shareholder. So what that means is that we need to avoid any corporate impoverishment. So the company's portion must equal a gradual cost or the proper cost of what the resulting same coverage would be for a term policy. But more importantly, the shareholder must pay their fair share of their total premium in order for it to be return of premium non-taxable back to them. So a shareholder agreement is required, but to be signed by a lawyer. We provide a sample to the client or to you, the advisor. So this is something that we provide all the materials that you as the advisor and the client need, both the summary of legal and tax basis. We have all of the CRA technical bulletins posted on Webby. We also have a frequently asked questions. We have a summary document on how to structure it as far as holdco or opco. So we essentially have created every single document that you as the advisor and for your clients and accountants. Okay, so our policy covers acquired brain injury. So if you noticed, we cover 26 covered conditions. One of those covered conditions is acquired brain injury that's only covered by four carriers total. And what that is essentially a concussion that lasts longer than 180 days. So we know that 80% of concussions resolve after 30 days, but that 20%, those that go on after 180 days, that would be a full claim payment. We also include long-term care built into our policy. So it's a full payment on the inability to do 2 out of 6 daily duties. But we also pay a partial advance payment of 15% if it's deemed to be a temporary loss of independence existence. So many advisors are not aware that in order to claim the full claim payment on long-term care, it must be permanent with no chance of recovery. We will also pay a 15% advance if it's a temporary situation. Okay. So for those of you that aren't aware of our product and how we will actually pay on any and all non-life-threatening cancers an advance of 1%. So this is no matter what, even if your client has a basal or squamous skin cancer, we will still pay that advance of 1%. So this is really good to know that no matter what, when your client says they have cancer, you know it's a claimable event. Okay, here we also cover a 15% advance for total mastectomy and total prostatectomy. We're the only carrier that essentially will pay that. No other carrier covers that. We have a whole list of actually cardiac related covered conditions that we cover, but other carriers don't. So all carriers now are covering, of course, the advance of the coronary angioplasty, but we have a whole list of cardiac related conditions that we cover. For example, the insertion of cardiac pacemaker. Okay, this goes on to essentially state what I mentioned about many advisors don't realize that a full claim under long-term care, it must be permanent with no chance of recovery. If the individual is thought that to recover, that's a decline under a full claim, whereas we would pay an advance of 15% on that. Okay, we're going to go through a case study of exactly what our shared ownership CI, also branded the Executive Health Plan, and it's coded a proper EHP product within our system. So here we have an example. So 37-year-old non-smoker, incorporated property development company. Her annual income is about $500,000. Now, well, the company's annual income. She does have 2 full-time employees. Now, she will likely work past age 65 as long as her business is doing well and she enjoys her work. So Sarah, of course, is concerned about the potential effect of her company on her company and staff if she has a critical illness. But she's also really likes the idea of being able to take money out of retained earnings and use it towards her retirement in 20 years. Or later. So essentially, these questions is how much longer will you remain active in your company? Or how much longer will your company require the insurance coverage on your health or ability to work? And why does that matter? It's the company's need will determine the length of coverage it requires. Now, remember I mentioned that the shareholder must pay their fair share of the overall premium on the return of premium portion in order for it to be return of premium non-taxable and to ensure the CRA does not deem it to be a taxable benefit or a shareholder benefit. So what that means is that the coverage duration must be reasonable for the amount of insurance, and the amount of insurance must be reasonable. So essentially, if we have an individual that's earning $40,000 a year and they're trying to purchase $3 million in coverage, we would essentially just want to make sure we have the financials to back up essentially why they're purchasing so much coverage. Okay, so for the solution we've done is $1 million of health priority. So it's a business CI coverage with return of premium on death. And essentially, we also have the health benefit. So that's the return of premium on surrender, 100% of premiums for 20 years. So what that means is it's return of premium after 20 years. So in the next slide, we'll show you the essentially the chart. I'll skip that portion because we'll say this is a better thing to focus on. So here we show where Sarah is going to be paying essentially, 32% of the overall premium based on getting her money back at age 57 or any time thereafter. So the total premium, you can see the company is paying 68% out of their retained earnings, and Sarah is paying the 32% of her portion of premium with after-tax dollars. So she would essentially be receiving a bonus, extra salary or dividend income, and then she would pay that. So we're the only company that can accept 2 checks on an annual basis. So Sarah could pay her portion in a check, and the company can pay their portion in an annual check, as well as one of them can pay credit card up to $10,000 per year. And all of our policies can actually be paid by credit card, MasterCard or Visa annually, all years, automatic billing up to $10,000 per year. So Sarah could actually use her personal credit card for points on an annual basis, and the company can pay their portion with a check. And then there's nothing that the accountant needs to be done on a tax time. So what we're showing here is how it's displayed within our report for the client. So I find this very, very useful because we like to explain things with a picture here at Desjardins. So the first scenario is, unfortunately, Sarah has suffered a critical illness and $1 million gets paid to the company. So the beneficiary is the company, $1 million gets paid to the company. The second event is, unfortunately, or the second scenario, so it's only one of the 3 events. So the second scenario is, unfortunately, she's died. So total premiums paid by both the corporation and Sarah will go back to the corporation non-taxable. Now, remember, we also have something within all of our CI policies for return of premium on death. We will pay a minimum of 25% of the insurance amount back to her or back to the company. So if, unfortunately, Sarah were to die, then a year into the policy, the corporation in this situation is going to receive $250,000. The third scenario, of course, this is what we want for ourselves, if we're incorporated, and for all of our clients, is that we remain healthy and we have the ability to surrender the policy. So at age 57 or anytime thereafter, we're going to get 100% of total premiums paid, both by the shareholder and by the corporation, back to Sarah, non-taxable. So this is where I say it really is that ability to take money from the retained earnings from the corporation back to Sarah in a non-taxable way over a 20-year period. So we see here that Sarah paying that 32%, she's really paying her fair share of the overall premium based on the coverage duration and her age to ensure the CRA does not deem this to be a shareholder benefit. So this is where we structure it, and we actually illustrate this for you. You don't need to do any calculation here. Within our software, we will calculate exactly what Sarah, the shareholder, needs to be paying to ensure it meets with our interpretation of those CRA technical bulletins to avoid it being deemed a shareholder benefit. Okay, so that's essentially it in a nutshell. I know we're at 11:57, or for me anyway, but I will go to the questions now. I'll go to the questions. We have 3 minutes left. Now, essentially, we have a question about how about polycystic kidney disease in case of kidney failure? I believe I'll just have to check on that one. I don't believe that's one of the covered conditions, but I'll check. It's consistent. We have standard definitions across the industry, so I'll see if there was any coverage for polycystic kidney disease under any of ours. And then is the covered illnesses okay, so someone's asking if the covered illnesses are the same as individual critical illness. And yes, so our individual CI policy is exactly the same policy with all of those extra covered conditions, extra cancers, total mastectomy, total or extra cardiac related conditions as well. And then someone asked if DFS, so if Desjardins paid a partial, so the 15% advance upon return of premium, does DFS refund the face value less the advance? Yes, they would. We would reduce the advance. So you can claim an advance up to 5 times. And okay, why would businesses want to purchase this health plan as opposed to buying CI with their group benefits plan? What are the differences other than better coverage? Okay, really great question, Xenia. I think this is really important so what I'm going back to saying here, so when your client has group benefits, that of course they have that great premiums, great ability to have that coverage, but that group benefits plan that they're purchasing, the coverages are of course different. So we talked about that and you're aware of that, but really is as far as it pays to them personally. Now, but this plan is really a way to pull money out of that corporation and out of the retained earnings, non-taxable, back to the shareholder. When you do a group benefits plan, remember, there's no return of premium on that. There's no health benefit, so it really is that yes, it's always great to have CI under the group plan. Definitely, I recommend that. I think that's really great coverage for very, very minimal cost for all employees. So definitely something I'm an advocate of, but this is something that is so great as far as you can purchase much higher limits. You can be underwritten properly for it to ensure that you have the coverage and that it will pay upon time of claim. Obviously better coverage, but also that return of premium and where you're pulling money out of that corporation non-taxable. Any other questions that people want to put into the chat before I sum it up? I know it's a very, very quick little thing there. So we just say it's essentially a win-win, for her as a business owner, as her company is protected. And then essentially Sarah, has the coverage and then will receive all the money back if she doesn't have a claim. There's one other question. Do all shareholders have to have it from CRA point of view? No, they don't. It's not like a wage loss replacement plan, which is the corporately owned disability. It is different where not all shareholders have to have that. So thank you.